Welcome to This Explainer. Today, we're going to break down how high-income earners can turn generosity into an incredibly powerful financial strategy, maximizing both your impact and, yep, your savings.
So let me just ask you this straight up. When you give to charity, are you leaving money on the table? For a lot of high-income earners, the answer is surprisingly yes. See, without the right strategies, you could be missing out on some major tax benefits that could actually let you give even more. So let's dive into why that is. This is the classic giver's dilemma, right? You want to make a real difference for causes you care about, but you're also looking at a pretty hefty tax bill. The great news, though, is that you really don't have to choose between the two. Strategic giving lets you do both and do it really, really effectively. Okay, so before we jump into the really advanced, cool strategies, let's just do a quick refresher on the foundation of all of this, the basic charitable deduction. So the crucial point here is that this deduction directly lowers the income you have to pay taxes on. And that means the higher your tax bracket is, the more a deduction is actually worth to you in cold, hard cash saved. It's that simple. But of course, the IRS does set some limits on how much you can deduct in 1 year. As you can see, for a straightforward cash donation, it's typically up to 60% of your adjusted gross income. If you're donating appreciated property, like stocks, that limit is usually around 30%. All right, now let's build on that foundation. We're going to get into 3 powerful strategies that go way beyond just writing a check. These can absolutely supercharge your giving. First up is the Donor Advised Fund, or DAF. The best way to think of this is as your own personal philanthropic bank account. It gives you incredible flexibility because it lets you separate when you get your tax break from when you actually give the money away. And the process is just wonderfully simple. You make a contribution to your fund, let's say in December. Boom, you get the full tax benefit for that entire year. Then, you can take your time deciding exactly which charities to support, sending out the money over the next few months or even years. Now, one of the key benefits here, especially if your income tends to fluctuate, is a strategy called bunching. Let's say you have a fantastic income year. You can contribute several years' worth of donations all at once, maximizing your tax deduction when you're in that higher tax bracket. It's a really clever move. Okay, this next strategy is one of the most efficient ways to give. Period. And why is that? Because it lets you completely sidestep a major tax. We're talking about the capital gains tax. This slide really shows you the critical difference. If you sell a winning stock first, you have to pay capital gains tax on the profit before you can donate what's left. But if you donate the stock directly to the charity, you can avoid that tax completely. Let's walk through a quick example with a tech exec named Sarah to see just how powerful this is. All right, so let's say 5 years ago, Sarah bought stock in her company for $10,000. She believed in the mission, held on to it. Fast forward to today, and that very same stock has skyrocketed in value. It's now worth $50,000. That's a fantastic return. And here is the magic. By donating that stock directly to her favorite charity, she completely avoids paying any capital gains tax on that $40,000 profit. Plus, she gets a tax deduction for the full $50,000 market value. I mean, come on, that is a true win-win. All right, our final strategy is a fantastic tool, but it's specifically for retirees who are looking to be really tax efficient with their required retirement withdrawals. And this right here is the key takeaway. You can satisfy your required minimum distribution for the year, that's the money the government says you have to take out, without that money ever hitting your tax return as income. This can be huge, helping lower things like your Medicare premiums and even reducing taxes on your Social Security benefits. Of course, to make any of these awesome strategies work, you gotta play by the rules. The IRS guidelines are really important here, and while they're not super complicated, they are crucial. So think of this as your quick pre-donation checklist. You've got to have the right documentation. Get those receipts. For bigger non-cash gifts, you'll need an appraisal. And always, always double-check on the IRS database that the charity you're giving to is a qualified organization. And of course, be honest about any benefits you might get in return for your gift. So how do you take all these pieces and put them together into a cohesive plan? One that doesn't just save you on taxes, but that truly reflects your values and what you want to accomplish in the world. It really is a simple 4-step process. You start with your why. What causes matter most to you? Then you look at your what's. Which of your assets make the most sense to donate? From there, you choose the right tools that we've just discussed. And then finally, and this is so important, talk to a professional. A CPA or a financial advisor can help make sure your plan is perfectly optimized just for you.
Ultimately, this is about so much more than just a tax deduction. It's about using smart financial tools to amplify your impact and create some lasting positive change. So the final takeaway is this. It's not just about how much you give, it's about how you give.